Hey, Jason. Hey, Susanna.
Hello.
Hello, hello. Thanks for joining. Jared, that looks like a good setup right there. Give folks, a little bit of time to come in here. All right, Marissa, if you'll just keep letting them in as they come in. Welcome everyone to our final Lunch and Learn webinar, presented this time by KeyBank. Nathan Flynn and Kelly McNary, very excited to hear about American infrastructure, which is a huge topic, and everything obviously that we hear about nowadays affects state government, local government. And I think for our communities and innovators, a great topic to kind of get up to speed on, because it is really changing the conversation, changing the way we think about, obviously the way the country's moving. And so this is our last in a series. And after this, tomorrow on Friday, we will do the Solution Science Fair, where all the innovators, if they choose, can jump on and present a little bit about the challenge they worked on, the solution they came up with, and just celebrate each other before we move into our closing ceremony at 10 o'clock Eastern on Saturday to close out Flipping Finance Challenge 2022. And so with that said, I will turn it over to Kelly and Nathan.
Great. Well, thanks, Mark. I'm going to kick things off for KeyBank. I'll just give you kind of a quick introduction in terms of my background, and then turn it over to Kelly to get the presentation started in earnest. But my name is Nathan Flynn. I'm a managing director in the public finance department at KeyBank Capital Markets. I'm based in our downtown Indianapolis office, although I work on public infrastructure projects across the country. This is actually my 25th year working in public finance. So in addition to being old, during that time, I've had an opportunity to work with all different types of investors on many different types of projects. So I've been fortunate to see a lot and experience a lot of different types of public infrastructure funding sources. And really, at the end of the day, that's what our job is as an underwriter, is to source capital for public infrastructure projects. So, to reference the 1996 movie Jerry Maguire, which is why our title was called what it was, we're the people that show you the money, right? So, we're in the same way that in that movie, Tom Cruise connected his clients with people with money, we connect people who want to invest in public infrastructure projects with the governmental clients who need that money for their projects. So what we'd like to talk about this afternoon is, who are these investors? Why do they want to invest in public infrastructure projects, and how do they go about investing in those public infrastructure projects? We've broken it down into 4 basic categories, but I'll note at the outset that these are very high-level categories. So I want to recognize that we're painting with very broad brushstrokes. We're going to make a lot of generalities. We'll leave a lot of important facts out, but with the time that we have and wanting to leave time for questions and answers, we wanted to provide what we could. So with that, I'm going to put our presentation up on the screen and turn it over to my colleague, Kelly McNary, to give her background and discuss the first category of investors.
Hello, everyone. Good afternoon. So I am Kelly McNary, again, also KeyBank Capital Markets. So I have been with Key for 10 years, been in public finance for, about 18 or so. So always been fixed income, always been in Indiana. So I traditionally work with local governments and kind of more the traditional, what would you think of in public finance? And Nathan's kind of more on the P3 side. So we're going to talk through all those different things. If you can, in our world, there's always some disclosure. So we'll roll past the disclosure, but it's there for legal purposes. We are a regulated entity, so we had to get our securities licenses and go out and pass tests to be able to do what we do. So that's some of what this language covers. So I thought we'd start kind of just in general, why do people need to issue bonds? So I know some of the presentations this week have covered kind of the legal process on how that works and, some of the different steps that go into that. So as we look at this, there are several reasons people might need to issue a public deal. And if you can go to the next one, Nathan, please. Oh, one more. Thank you. So, nope, too far. So for a new money project, if you need a new school built, you need a jail, whatever the purpose may be. So you might have a new money construction purpose. There's also times when you can refinance those bonds that are outstanding or do a refunding and try to take savings. So, most of the time, if you're doing a refunding deal, just like you would with your mortgage, you can, if the rates are lower, you can refinance, try to get a lower payment, or you can refinance, try to pay it off in a longer period of time, shorter period of time. Same thing with these, just a few more steps that go into it. So those are some of the main reasons that we would see a refunding issue being done. And sometimes, entities can get into financial trouble and they need to consolidate or restructure some debt that they have outstanding. So that is another purpose of a refinancing. And sometimes just your situation has changed. And so sometimes you need to do a refinancing to change some covenants or some legal restrictions that you might have had when you initially sold, and good or bad, your situation has changed. And so you do a refinancing to try to get around some of those covenants. So those are some of the general reasons why people would go out to the market to try to issue, capital markets debt. So we are known as your underwriter. So as we're the person kind of stuck there in the middle. So the person on the left is the issuer, which is typically, the municipal government. It's a city, town, school district, state, and they need to sell bonds to finance a project. They need to build something, a road, a school, and they don't have that money sitting in the bank. And the way that they get that is, property taxes, sales taxes, revenue over time. So they can't just go out and, get a loan and say, hey, we'll pay this back, we promise. There's a whole different setup to do this. And they don't typically get in the market at all the time. So they are not aware that the market is not behaving well lately. You're hearing reports about, inflation and all these other things. So that affects our markets and what rates are doing. So most issuers aren't in it day to day to know what's happening. They also don't have the ability to take a risk. So if, somebody comes in and doesn't want to buy all the bonds, or rates are a lot higher, government agencies cannot take that risk in the market. And obviously they want the lowest possible yield out there. They want to pay the least amount of money, which again benefits taxpayers down the road. So on the other side are the investors, and they're the ones who have the money. Those are the people that, we're going to talk about. Who are these investors down the road? They want to buy bonds. They typically don't have direct access to an issuer. They don't know who the clerk treasurer is of, whatever town in Indiana. And, they, are the ones that are willing to take the risk. They get paid to take that risk, and they do an assessment on each credit as to whether it's worth it to put it in their portfolio and move forward. And obviously, because they are investors, they are trying to get the highest possible yield that they can as a return. Kind of in the middle is us as the underwriting firm. So we are in the market every day of the week, and we generally know when investors' preferences are changing. There's sometimes people get risk averse because maybe there's a war in Ukraine. So there's lots of different things that we see as we're looking at the market on a daily basis that we pay attention to. And we know, again, sometimes the investors will want additional features to protect themselves, or sometimes when there's not a lot of bonds out there, they're willing to take some concessions and maybe not require as much in the market. So what our job's to do is to find, we put it out there and say, we have this deal, let's find the investors, and we try to put everybody together. As part of that, we take a fee in order to do this, but we also take some risk in this transaction. So part of our fee is to also say, if we don't get all of this sold, market changes, things happen day of sale, we will underwrite, we will put that in our portfolio and take that risk that those bonds move over the next few days, good or bad. Sometimes it's good for us, sometimes it does not go well for us, but that is our job, to underwrite those bonds. That's what we are paid to do. So our fee can be dependent on, the risk structure. If it's a non-rated deal that's probably not going to have a lot of investors interested in it, we're probably going to charge a little higher fee just to cover our risk in the transaction too. So our job is to kind of balance between the two, the investor and the issuer, to make sure that we find a good spot for kind of both those parties to get the transaction completed.
Yeah.
Anything to add, Nathan?
Yeah, I was just, yeah, you can tell I was getting ready to say something, couldn't you?
Mhm.
We've done this enough times. I was just going to say that, yeah, I mean, we really are, dorky matchmakers. We're matchmakers that are good at math, right? Because it wouldn't be an efficient market. There are hundreds of institutional investors and millions of retail investors, individuals that want to invest in public infrastructure projects. And then there are tens of thousands of municipal units of government that want to raise capital in this way. And if there wasn't this, this middle person that was connecting those two groups of people, it would just be chaos. Marion County is going to get a call from, State Farm one day and another investor the next day. And so, we just kind of compile both sides. And for purposes of clarity, not to drill too far down, as underwriters, even though we're connecting two different sides, we actually, as individuals, typically face one side. So for instance, Kelly and I, as investment bankers in public finance, we face the issuers, and then we have a sales and trading desk that faces the investors. So Kelly and I don't typically, if you think about our everyday activities, we're typically talking with investors or working group folks like legal counsel, municipal advisors, trustees, and not so much talking with investors. If we want to have investor dialogue, we will typically talk to our underwriting or sales desk folks.
So in general, high level, so the bond issuers are kind of listed at the top. So your municipalities, the state, cities, counties, utilities, not-for-profits. I know that's come up a couple times this week in some of the presentations. So they can all access, the capital markets for tax-exempt bonds. Again, we kind of covered some of the different uses of those projects. And again, they can be, depending on the project, tax-exempt or taxable. They can be fixed or variable, or sometimes there are other structures, like you can have capital appreciation bonds where you don't pay any principal and kind of pay things back at the end. And then there's different optionality on it. So sometimes you can structure it where there's a call feature that if rates have, changed and gotten lower, you can refinance them. Sometimes you're locked in for the life of that bond deal, however long it may be. So these are all the different things that as we're putting the transaction together, we work on these different structures. So in the end, there's, like Nathan mentioned, there's retail investors and institutional investors. So, typically, there's private investors like you and I that try to go out and, buy different things in our individual accounts. But then we typically deal with the larger investors. We see bigger block sizes of, you're not buying 100 shares of something, you're buying, multiple millions of dollars size block sizes of these bonds. And these institutional investors are the people that we all have probably a pension or 401k or something to that effect. These are the people that manage those funds, the asset managers and things like mutual funds. There's also insurance companies like USAA, State Farm. Those are all big buyers of these types of securities.
Yeah, and part of that speaks to the why. So why would when you think about what is a pension fund, what does a life insurance company want out of their investments? Hopefully, life insurance companies are taking in small amounts of money through your premium, and then a long time from now, after they write that initial policy, they're paying out a death benefit. And so what they want is they want an investment where it's very safe. There's not a lot of volatility, where there's a large return of principal at the end. And that's exactly the profile of most, municipal bonds there. So if you're a life insurance company, you're probably not buying bonds that mature in the first 5 to 10 years of an offering. What you're doing is you're buying those final maturities, those 20, 25, 30-year maturities, because that's when you want your capital return. And, the same thing for pension funds, right? They're trying to find these stable assets for that portion of their investment portfolio, and the municipal bonds fit perfectly in there. So it's a good fit for what the investors are looking for, and what the governmental entities are looking to do from a payments standpoint. You ready for the next slide, Kelly?
Yes, please.
All right.
So there's traditionally, I will say, been kind of two different ways to sell municipal bonds. Back when I started, it was kind of these two ways, right? So there's competitive and negotiated sale. And some of these are determined by statute. You are required by different state or local laws to sell a certain way. And sometimes it can be a preference. But so for a competitive sale, it's very transactional. So at a certain date, at a certain time, you send out notice that you are going to sell your bonds, and whoever has the best bid at that time is the winner. So it is mostly handled by a municipal advisor, a registered municipal advisor. They send it out, they get sealed bids. Again, there's different procedures to, notify the public of the sale and everything else. But it is truly just whoever has the lowest net interest cost or true interest cost, depending on the bid specs, wins the deal. So at closing, typically 2 weeks later, the underwriter sends a wire with proceeds, and we take off our underwriter's discount. It's nice we get to call it a discount, I suppose, but we discount your wire for our fee before we send it to you. So we take that fee off, send you the rest of the money, and you go on to fund your building, do your construction project, whatever the proceeds are for. So in that instance, it's very transactional. There's not a lot of kind of working group that we talked about earlier this week that get together to kind of talk through the transaction. It's, you're done and closed. And most of that is kind of handled by your bond counsel and your municipal advisor. On the other hand, where we would more so come in is on the negotiated sale. And this is what I see as more of a relationship-based sale. So we have a lot of clients that we have worked with for many, many years and done many transactions for them. And so when a school district, say, has their next project, they call us up, they call, their municipal advisor, bond counsel, it's time to get the gang back together. I have a project that I want to do. So we get together as a group and determine the best structure, the best timing, as a team to determine how best to do this. So as we go through it, we are in there the whole time. We're helping them structure it to make sure it's something that the market is going to take. Again, the market changes. And so we help along the way to make sure that it is being structured to get them the best deal in the end. And then we work with our underwriting desk to, again, make sure that we are up on kind of where the market is at that current time. So as we go through this, we put together the offering documents. We're fully engaged in that. But then the big part of it is on a competitive sale, when you put it out for a certain date and time, who knows what's happening when you post it 2 weeks in advance and say, hey, we're going to sell on this date and time. Something could change, right? An inflation number comes out, or Russia does something with a, ballistic missile, you just never know. So when things like that happen in a competitive sale, the market can get spooked. And if they don't have buyers ready, or they don't have good, good indications from buyers, a lot of underwriters will back up and say, well, this is not worth the risk. And then that issuer maybe doesn't get as many bids or as good of a bid as they may on a day when the market is calm and everything's kind of boring. So what we can do on our side, when we say we're going to sell these bonds in a negotiated sale, we work with the desk. And if something is happening in the market, we can pull that back and say, okay, hold on, we're going to maybe look at doing this later. Or, hey, we know this could be happening next week. Let's give it a little time before we go into the market, and we can help kind of control and manage that market risk a little bit better on the negotiated side. So again, we are fully involved, helping and working with the issuer as they go through that process. And again, as we sit and work with that working group, we can say, for example, we just did a deal with a school district that I've been working with for many years, and they had a refunding transaction and a new money deal. So because we had that relationship, we structured the new money and the refunding together, which allowed them to get better savings, better efficiencies in the deal with cost of issuance. So that is some of the benefit of doing a negotiated sale from our perspective.
Yeah, and I think it's, the important thing to note is these are the competitive sale versus negotiated sale. These are two different paths, but they're both considered, or at least what we're calling a public sale. And the reason we say that is if you're an institutional investor or even a retail investor for the most part, we'll dig into it a little more down the road in our presentation, but these are transactions that are open to you. So they're advertised, they're known in the investment community. And so they're public in the sense that the extent to which you're an investor and you would like access, you would like to invest in these projects, you're able to do that. Next.
So again, there's, kind of different reasons for maybe looking at a competitive sale or a negotiated sale. Again, we might be a little biased because we work on the negotiated side, but obviously our desk bids on all these competitive transactions. So there is a role for us as a underwriting firm, but if it's a general obligation, a traditional municipal transaction, it can go either way typically, whether you want to go competitive or negotiated. It's when you start, we kind of say when there's a little hair on a deal, when there's something a little squirrely about it, you have a story to tell. Those are where we like to do negotiated sales. We like to actually get in front of the investors. We can do, investor roadshows, talk them through the transaction. Sometimes if people think there's something out of order, there's a concern, they will back away from a deal and or unnecessarily add extra, yield to a deal because they don't understand it. So it is our job to walk those investors through the transaction, make sure they understand it, in order to get a better rate for the issuer overall. So that's sometimes where credit quality, the lower rated deal or something like that, it's beneficial to go through a negotiated sale.
Great. Well, and so before we talk about that, the next investor class, the folks that look at limited offerings, to kind of wrap it up on the public sales, I did get a chance to watch the Lunch and Learn on Monday about careers in public finance. And I would say one of the other areas that wasn't discussed on Monday was being on the buy side. So typically when we talk about careers in public finance, we look at it from an issuer standpoint, the municipal advisors, the legal counsels, the trustees, the underwriters, et cetera. But again, there's that other side of the table, the investors, where they get into that field for many of the same reasons that we all get into it on the issuer side of things. They're looking to, again, invest in American infrastructure, and all these amazing public projects wouldn't happen without that side of the table as well. And so, as during my career, as I've met a lot of the people on that side of the table at conferences and as such, I found that they have many of the same interests. They like seeing the fruits of their labor. They like, at the end of the day, knowing that they were a participant in a project that benefited a large group of people. So, so for the folks on that side of the things, as underwriters, when we're pitching ourselves to our clients, a lot of the times we talk about how we have a unique in with the institutional investors. And that's true to a certain extent. The reality, though, is when you think about the hundreds of institutional investors that there are, typically most underwriting firms will all cover each of those institutional investors. And the reason I bring that up is for public sale, what that means is if you're an investor, if you're an institutional investor, you're likely going to see most deals that are out in the market. You walk in the morning, you open up your Bloomberg, and you've got from your different underwriters that cover you, you've got all the different deals that are out there. So you've got the opportunity to select what deals you want to invest in. To a lesser degree, the same is true for retail investors. So again, a retail investor is an individual, what we sometimes call mom and pop investors. They have access to the public offerings, with the caveat that they have to have a brokerage relationship with one of the underwriters on it. What I'd like to talk about next, though, are limited offerings. And so limited offerings are transactions that aren't public in nature, but they're still securities, they're still considered bonds. I don't know what the exact statistic is in terms of the volume in the municipal market, but I would suggest that the vast majority of municipal debt is issued through the public markets, either through a negotiated or a competitive sale. But the limited offering, it's an offering of municipal securities that's sold directly to investors rather than being purchased by an underwriter and then passed on to institutional or retail investors. And these are often called private placements. So, and the folks that buy these are what's considered sophisticated investors. So in order to qualify to purchase a limited offering, you have to be qualified as a sophisticated investor. And so, what makes these sophisticated investors unique? I would use the analogy that we see in math, because I'm a math geek. So every square is a rectangle, but not every rectangle is a square, right? That's one of those truisms in geometry. And in the same way, every sophisticated investor can purchase securities, municipal securities, through a public market sale. But not everybody who is an investor in the public markets can purchase securities via a limited offering. So I would say that generally speaking, the deals that we price and source capital through via a limited offering are ones that require a little more due diligence and analysis. And the reason that's important is an investor on most of the public market deals, I don't want to oversimplify them, but they're typically they typically have a bond rating from one of the rating agencies. Every deal is unique, but generally speaking, a AA GO is a AA GO. And so as an investor, you're going to look through the preliminary official statement, which is this large legal document with all the details. And you're going to see what makes that deal different, make sure you get credit approval, but generally speaking, it doesn't take a lot of due diligence. It doesn't take a lot of your time. On limited offerings, these are deals that require a lot more diligence. And so typically speaking, you're willing to do that diligence if you think you have a good chance of actually being allotted the order if you approve it. And so on a limited offering, if as a potential investor, if you know that these securities are only going to 35, let's say, potential investors, you're much willing to put in that time to dig into it than if you know that hundreds of folks are going to take a look at it and you're just hoping to get an allotment. As such, a lot of the structures that are sold via limited offering are non-rated. They don't carry a rating from one of the rating agencies. And they typically don't have what's called an official statement. And again, that's that legal document that's put together by counsel or the municipal advisor that has all these kind of descriptors about the transaction and some legal protections. So they're still securities. They're still subject to SEC and MSRB rules and regulations. But it's effectively just a truncated process to that more expansive public market offering. It's a little more of a back and forth in a negotiation. So the role that we would typically play as an underwriter in a public offering, that role in the limited offerings is called a placement agent. And one of the reasons it's called a placement agent as opposed to an underwriter is that in a public sale, as Kelly described, if there isn't interest in all the maturities, one of our jobs is to take those unsold balances down and hold them until we can find buyers for them. In a private placement, as a placement agent, you don't take that risk. You don't actually underwrite. So rather than purchasing the bonds and then passing them on to investors, you truly just act as that matchmaker. It's a direct relationship between the issuer and the purchaser. So again, just a different way of doing the same structure. It's still a municipal debt security. It's just a different path, a different way to get those investors to the projects. So I'm going to turn it back over to Kelly, and she is going to talk about direct bank loans.
Yes, well, I will say one of the best things about our job, we should say this, is annoying your family and your children as you drive around town and go, I financed that school and we help with that road project. So, perks. That's what my old boss used to do on every road trip. It is nice to be able to see the fruits of your labor, whatever that looks like, right? So this is kind of a new thing. Well, not quite so new, I guess, over the last 10 years. So there were some changes to the market back in 08, 09. And so, there were some tax changes and things like that. So it became a little more lucrative for banks to, look at some of these municipal bonds and put them in their portfolio. So, when you go to a bank and you deposit your paycheck and whatever that looks like, the bank turns around and they offer loans with your funds. So as part of that, the credit team can look at investing in some of these municipal bonds or municipal loans and put them into their bank portfolio. So when an issuer wants to go this route, a lot of times it's maybe a small size transaction or a shorter tenor transaction, so it doesn't go out very far. And so they will work directly with the bank, with their municipal advisor and a placement agent to go ahead and kind of put together this. It's a loan. It is a bank loan. Traditionally, they don't have a QSIP or an identifying security that goes with them because they are not a municipal bond. They are a loan. So years past, there was a lot of talk of, hey, you should do this bank loan instead because you don't have to do as much disclosure out to the market. So in recent years, if you buy a stock, if you buy, any other corporate bond with regular increments, they are required to post financials so that everyone knows how they are doing. Municipal governments didn't quite do that as regularly. And so, in some of these financial times that we've had in the last few years, 08, 09 with the financial crisis, there were a lot of the market regulators were concerned that the investors weren't hearing about changes to the issuers fast enough. And with these bank loans, they weren't required to post disclosure items either. So if they had, 10 different bank loans out and you held a public bond, you didn't know about these other bank loans. And it could be a drag on your security if something happened to that issuer. So they started, pushing more so requiring that issuers disclose when they have bank loans and, post information about their financials. So it's not really as advantageous maybe as people were pushing for a while as to why you should go this route as opposed to a public market. So when a bank looks at a transaction, typically they are restricted on the length of the deal that they can do. Most of the deals that we see new money in the public market are 20 years. I would say not all banks can go 20 years or are willing to put their capital out for 20 years. So maybe they do a 7 to 10, 12-year deal. And then they have, a put feature where at the end of that structure, you have to renegotiate with that bank. In the public market, you do a 20-year deal, you probably have a 10-year optional call. And if in 10 years, it looks, it's advantageous to you financially, you can refinance it for savings. You don't have to, but you can. With a bank loan, you have to figure out a new structure, either with that bank or a different way. So if the market is in turmoil or, rates have gone up, there is some market risk that you have then because you have to renegotiate that bank loan. So just some other things. Sometimes banks are also restricted in terms of if they have a whole bunch of higher ed credits or they have a whole bunch of, public school credits, they might restrict that category. So it can kind of depend on what their portfolio looks like and what the bank is looking for at a certain time as to whether they would even be interested in your transaction.
Thanks, Kelly. And yeah, I guess the way I often will think about it is, bank loans are very similar to the limited offering market. It's just that it's going to a different investor group. The limited offering market is institutional investors, your insurance companies, pension, bond funds, et cetera. Whereas in the bank market, it goes directly to banks, direct lending. And this is a market that's really evolved over the last, 10, 15 years. So both in terms of the types of loans that banks are willing to provide, as well as the disclosure that's required from both the regulators as well as the rating agencies. So, but yeah, very important market for sure. Okay, if we're ready, we're going to go. This is where I'm really going to get excited because the next market is public-private partnerships, and I love talking about P3s. So we're going to spend the next 3 hours talking about P3s, or what will seem like 3 hours. How about that? So what is a P3? A P3 is a public-private partnership, and really, it's a mix of both financing structure as well as project delivery structure. So before I talk about who the investors are in P3s, I'd like to talk about, why are there P3s? So you take a step back and you think about what are really the three goals of a public infrastructure project. I always like to think that as a government entity, I'm risk averse. And so my goals are on-time completion, minimum asset performance, and cost certainty. I want to know that the bridge that I'm building is going to get done on time. It's going to function over the life of the bridge. And I'd also like to know that it's not going to cost, or at least what it's going to cost, over not only up front, but over the life of that project. We also need to think about, who owns that responsibility, both the construction, the ongoing repair and maintenance, the operation of the asset, and the rate setting if it's a revenue producing asset or project. And then the corollary is who owns the risks? Who owns the risks of delivering it on time via construction? Who owns the risk of any initial cost overruns during construction? Who owns the risk of the repair and maintenance costs over time? And if there's a revenue component, who owns the risk that revenues will fluctuate? So again, I just said that I think of government entities as being risk averse. But oddly enough, the traditional delivery method that we've used here in the States for public infrastructure projects is quite the opposite. It puts all the risk and responsibility on the public sector. So the way that most infrastructure has been delivered in the States is the design, bid, build process, in which, again, we'll take a bridge as an example. The state of Indiana wants to build a bridge over the Ohio River connecting to Louisville, Kentucky. And so they go through the design process, they get 25% design, and then they'll bid out the individual components of the project. And they've got a completion date in mind, but a lot of times these large infrastructure projects, they run over. So, and they don't really know the final cost until they're all the way done building it. And so the public sector owns all the responsibilities and all the risks. And that includes the cost of maintaining that asset over time. I will say that we all know, if you've ever owned a car, you understand that changing your oil every $5,000, or sorry, every 5,000 miles is more expensive than not changing your oil every 5,000 miles. So you can save up some money on the front end by not changing your oil. But I think we all recognize that if you continue to do that, you're going to have a costly repair in the future. Your engine won't last as long. It won't perform as well. The same thing is true for buildings, for water and sewer systems, for roads, for bridges. But as public officials, you get kudos for building things and you get kudos for saving money. You don't get kudos for putting down that repair on the road 10 years after it was built. There's no ribbon cutting for ongoing maintenance. And so as a result, oftentimes public infrastructure projects don't get that ongoing repair and maintenance that they need to lower the overall costs. And that's due in part to the way that we've traditionally delivered infrastructure here in America. So the next step on this continuum of shifting risks and responsibilities over from the public sector to the private sector is a design build, or what I like to call old school P3s. This is where, instead of doing a design bid build where you bid out the different components, as the owner of the asset, you go to the private sector and you say, this is what I want built, and I want you to give me the price. And if there's a cost overrun in the construction of the project, that's on your side of things. So just to kind of pick numbers out of the air, you could be talking about a bridge. It's $100 million is what we're going to pay for the bridge. And if it costs the builder more than $100 million, then that comes out of the builder's pocket. So again, we're shifting over the on-time delivery risk, and we're shifting the initial cost overrun risk. What we're not shifting is the ongoing repair and maintenance or the revenue risk, as well as the responsibility to finance the construction, to finance the repair and maintenance, and to do the operations on an ongoing basis. So as we continue to tip this teeter-totter, we move on to the next step in the continuum, which is a design, build, finance, and maintain, where now we're asking the private sector to finance the project, finance not only the initial construction of the project, but also the ongoing costs and the ongoing responsibility of the repair and maintenance. So it's important to note, a lot of times the nomenclature used to describe this as an availability payment because the government entity is making a payment to the private sector only when that asset is available. To some degree, it's similar to a lease payment. But the operation is still being done. So a good example of this, we see the structure a lot on governmental buildings, whether it be a courthouse, a city hall, sometimes schools, where the government entity is responsible for operating the building, but they're not responsible for the ongoing repair and maintenance, the HVAC, the windows, the roof, stuff like that. So it's similar to being a tenant in a building that you own, but you don't have a mortgage on. You have a lease payment. And then as we continue to tip the teeter-totter and move more things over to the private sector, we have a design, build, finance, maintain, and operate. The nomenclature, people often call this DBF-OM. They switch the M and the O, even though the M always comes first. But so this is where you've actually, the government entity has moved the operation as well over to the private sector. And so we see this a lot, again, on a toll road. The Ohio Rivers project is a perfect example. The state of Indiana entered into this sort of arrangement for that bridge. The state of Indiana still collects the toll revenue, though. So this is still an availability payment where the state effectively is making a lease payment to the private sector partner. The private sector partner is there's no man at toll booths, but analogously, they're manning the toll booths. They're doing all the work. They're picking up the roadkill. They're striping the lanes. They're doing all the stuff in terms of an operational standpoint. But it's still the state of Indiana that owns the bridge. It's still the state of Indiana that sets the rates. And it's still the state of Indiana that takes the revenue risk. So the extent to which traffic volumes drop and that toll revenue isn't sufficient to make that availability payment to the private partner, the state has to figure that out. So they still have the control and the risk from the revenue standpoint. And I'll say that a lot of P3s don't have a revenue aspect. So if it's an office building, if it's a road that's not a toll road, then the whole revenue part of things is not relevant. But the extent to which it is a revenue producing asset, the last tip of the teeter-totter, we're now all the way down and we're into a revenue concession where it is the revenues itself from the project that is making the funding to the private sector. So in most cases, because it's a governmental asset, the public sector still has rate setting powers, whether they be absolute or contractual, but it is the private sector that is now taking all the risks in terms of delivering that project on time, delivering it under budget, the ongoing maintenance costs, as well as the fluctuations in demand and revenue. So the natural question
related
is,
to those maintenance costs, I'll add, there are requirements for the private sector to do those things in certain time periods. So they cannot, totally let the road go to, disrepair, leave roadkill you mentioned, or, it cannot, there are requirements that they have to maintain in order to be given their availability payments and other things down the road. So they do have to do, maintenance and repair and keep up the assets as part of this.
That's right. And it's for that reason that equity investors are interested in investing in these projects, because debt investors, they don't like risk, they like certainty. Equity investors like the different, they seek out volatility because that enhances their rate of return. And so they're looking at those higher rate of returns. They're seeking out not only volatility, but they're seeking out projects and revenue streams where they can impact what that upside revenue is. And so as Kelly mentioned, in these availability concessions, there's a maximum payment. So if you as the operator do everything perfect, if you check off all 200 boxes in the operation agreement, then you get your full payment. But if, as you don't perform, as those boxes go unchecked, your payment goes down. And so, you know, in a parking arrangement, it may be that you're supposed to power wash the parking deck in certain intervals. And if you don't, if you fail to do your power washing in a certain time frame, your payment goes down. And so, you know, on the Indiana toll road transaction, which was one of the first P3s here in the States, one of the neat parts about the agreement is there's literally a requirement for how long roadkill can sit on the toll road. And if they don't perform, then their payment goes down. So, so again, that's, you know, as an equity investor, what you do is, you know, you kind of lever up the capital stack. You take, these are still municipal assets, so there's not a lot of up and down in terms of those payments, either the revenue or the availability payment. And so the way equity takes a very kind of boring revenue stream and makes it exciting is they will lever it up. They will basically in the capital stack say, well, we're going to fund 80% of this project with boring old debt, you know, boring old, whether it's municipal debt or bank loans or private placements. That top 20% of equity, because that 80% of debt is basically carving out a large portion of that non-volatile revenue stream, again, whether it be project revenue or an availability payment, they're left with the volatile portion, which is exactly what they want. And so that's how they get the equity returns that they're seeking, through the capital structure. And their whole play is, as an equity investor, we're going to hire operators that can make small changes that are improvements to the bottom line, whether that be cost reduction through technology or revenue enhancements. And so the folks that work in the public sector are great folks, but they don't often have access to capital. If you are running a parking system for a city, for a municipality, there may be technology out there that can greatly reduce costs or enhance revenues, but you have to fight with all the other city departments to get that $5 million for the new technology. And if it's, you know, if city council is faced with filling potholes, which voters can see, or implementing some new technology that's going to reduce expenses in a parking garage that most voters never set foot in, naturally they're, you know, that capital triage is not going to favor that. So the equity investor says we have, in theory, limitless access to capital, so we can improve the performance of this asset through our equity involvement. I will say that P3s are very common in other countries. It's often, so if you look at Canada, a lot of large, especially large public infrastructure projects are funded through P3s. But as a lifer in the municipal bond market, I want to say that I want to qualify that by saying the reason that is because most countries don't have tax exempt municipal bonds. And so, you know, here in America, one of the reasons why a vast majority of our public infrastructure projects are funded through tax exempt municipal bonds is the ability to have tax exemption as an investor, to get tax exemption on that municipal debt. So I'd say we have the best of both worlds from a cost of capital standpoint. So that is, I think that is it. We do have at the end of our presentation some market data, which we just kind of have in there as reference. But Mark, what I'd really like to do is the extent to which folks have questions or what have you, just open it up and take it from there.
Let's do it. And then maybe Nathan, if you stop the screen share, we can see everybody's faces.
If I can figure out how to do that.
There you go.
I got it. Okay, good.
We've bored another audience.
Professor Boylan, good to see you.
Yeah, always repping.
There you go.
I like it. I like it. Keep the hat on, actually.
Okay. I'm glad to see somebody else here has facial hair. The first day we came, I was the only one with facial hair, and I thought, oh, maybe everybody thinks I'm that crazy professor. It's in midlife crisis.
I would if I had the ability to grow it, but you know, it's my skill set is limited.
Actually, I like the presentation. I used to do bond trading for Lincoln National Corporation, where I was responsible for a $13 billion portfolio. I never knew what all was going on in the underwriting area. Because
Yeah,
they're
it's,
already on the market, secondary market.
yeah, in one of my first positions in public finance, I was fortunate that our investment banking group was on the same floor as our sales and trading group. So we had the benefit of having a lot of interaction with the folks on the sales and trading side, and as a result, the folks on the investing side. And yeah, it's a neat side of the market.
Yeah, I'll be able to add that to my class content.
There you go.
A lot of good information. I appreciate you sharing.
Absolutely.
Nathan, on the P3 side, what goes in at like at the local or the state government level? What are they looking at to decide? Do I do design bid build? Do I do, the full design build, finance, maintain? Because it seems like you'd always look to shift as much of the risk out, right, as you could. But what makes governments make different decisions?
Yeah, I would say a lot of it has to do with the nature of the project itself. So a P3 by its nature is more, I would say more appropriate, but it's probably more likely to be done if it's a very large project for a couple of reasons. That the documents and the kind of the bidding process on the P3 side of things is expensive for the equity investors. They'll often incur, millions of dollars of what they call pursuit costs, and they often incur those pursuit costs whether they win the bid or not. And so they tend to be biased towards larger projects, $50-100 million in size. It's not always the case, but it's not as common to see a P3 structure used for a project less than 50 million. And then, I would say, in terms of a lot of projects are such, so we do a lot of bond underwriting for public schools here in Indiana, and I would say, as neat as it would be to do a P3 for a public school, for K-12 public school, the reality is that both from a financing standpoint and a construction standpoint, that market is very efficient. So yes, they still, if they do a design bid build, do they incur some of those risks? Sure, but the folks that are doing that, they've done so many projects here in Indiana that it's a relatively minor risk. And then from a financing standpoint, the cost of funds for schools here in Indiana are extremely low. Most bond issues get done in the AA category, so the cost of capital is very attractive.
Yeah, we're seeing a lot in the P3 space on, higher ed university deals. So a lot of, or hospitals, they have a power plant, or they have, their utilities that they're running that all on site, and that's not their core mission. Their core mission is, educating college students. So we're seeing a lot in that space of taking some of those ancillary responsibilities off of their plate, give it to someone who's good at it. So that's what we're seeing a lot in those industries.
Makes a ton of sense. Other questions for Kelly or Nathan? Thank you both. As Professor Boylan said, this will be available not only to his students and his future use, but to everyone who's been part of Flipping Finance Challenge. And this has been just, I think, so great. Opened up, I think, just light on what that investor market looks like and the different ways that infrastructure projects can get done. And we hope to see everybody. Tomorrow will be Solution Science Fair for our innovators to come and just share what they worked on and where they arrived at as kind of a soft launch into what is Saturday, our event's closing ceremony for Flipping Finance Challenge 2022. You should all have the Zoom link for that. If you don't, let Brian or me know, and we'd be glad to get it to you. So we'll sign off from here. Thank you, Nathan. Thank you, Kelly. Thank you all for attending.
The opportunity to talk about it.
Thank you.